Hi everyone, welcome back. So 2020 is just a couple of weeks old and we have a lot of big news coming in. Firstly, in the US, the year started with the impeachment of President Trump. And in Asia, Hong Kong's protests continued into the new year with basically no clear end in sight. And now we have the coronavirus. It has affected over 2,700 people and killed over 80 people. So from Wuhan, it has spread to other countries including the US and Singapore, which is where I'm living in. So phew, that's a lot of things to take in, right, for the new year. But before we get all negative, a happy Lunar New Year to all of you who are celebrating it. Talking about the year of the rat, this portfolio is designed to help you get out of the rat race. You get it? This year is the year of the rat, and this channel helps you get out of the rat race. Both has rat in it. Alright, I'll start. Anyways, the last video I did, which is the very first video, was about the reasons why I chose dividend growth investing as my investing strategy. I went over how my portfolio, the one you're seeing now on the screen, is getting me passive incomes in the form of dividends. So the video did pretty well. You have gotten over 100 views in less than 2 days, so thank you very much for the support. And it seems like being able to get income without working is something that people are really interested in. So very quickly, let me sum up what dividend growth portfolio is all about. So I'm focused on getting income from these companies, and I'm focused on investing in companies that gives a consistent and growing dividend. And because of this focus, I'm not too concerned about short-term events like the coronavirus or some other thing happening in Iran or any other breaking news for the matter. Let's take a look at Sheng Siong, a grocery retailer in Singapore, and the company provides cheap, wallet-friendly groceries similar to what you'll find in the US like Costco. So whether or not there is a virus outbreak or not, people still need to get their weekly groceries done. If they want to avoid the crowd, they can do it online, and Sheng Siong has a website. But the point here is that when you have a dividend growth portfolio, companies in this portfolio tend to have a very resilient business model that has proven itself over many years. So as you can see, I focus on the dividends, and Sheng Siong paid me dividends of $30 for the past 1.5 years. I have a small position in it, so it's not too significant, but it's just money that I don't have to work for. So stable, predictable returns in the form of dividends is one of the reasons why I love dividend growth investing. Now, let's go back to the coronavirus and see how it will impact the stock market. We will be looking at a SARS event in 2002 to see how the market performs during a virus outbreak. On a personal note, do take good care of yourselves and your families, avoid crowded places for now, and see a doctor if you have to. There's no need for panic. We have gotten over SARS and we will get over the coronavirus this time too. So this is a timeline of SARS. And if we scroll down, we will be able to see when is the first outbreak in the US. So in March 2003, the CDC issued a travel advisory to people traveling to affected areas in Asia. Later that month, the CDC also held its first briefing on SARS and said that 14 suspected SARS cases were being investigated in the US. So in March 2003, we have the first outbreak in the US. So how did the S&P 500 perform? This index tracks the 500 largest companies in the US and gives us a rough idea of how the market react to this outbreak. Because it's so large, the S&P 500 will also give us a good gauge on how global market performs. As seen in the timeline, the market dipped around 4% in the next 8 months, but then continued its rise to the Great Depression in 2008. So the market may have gotten worried when the first patients got diagnosed with SARS and there was a real risk of an epidemic, but it quickly got over it as the spread is contained. Alright, moving closer to home, let's take a look at some of the impacts SARS had in Singapore. So this is the Straits Times Index, and from the timeline, the outbreak also happened in March 2003. So let's see how the Straits Times Index or the STI performed. From this graph, we see that the market dipped around 7% in the next 3 months as SARS became more serious. But once again, If we zoom out and take a longer term view, the market swiftly recovered and continued its climb as SARS didn't even happen at all. So from a broader market perspective, from the examples of the S&P 500 and the STI, it seems like the market experienced a dip for the first couple of months with a decline of around 5 to 10%, but subsequently both recovered and continued their march upwards. Of course, this may change depending on how serious the coronavirus is. My hope is that it won't be so serious as SARS, and we will be able to recover from this as quickly as possible. We have taken a look at how the broader market reacted to such a virus outbreak, but how will different sectors react to this? So I came across an article by the Business Times, and it basically highlighted that different sectors will react differently. The article went on to state that companies driven by tourism and those with exposure to China are more likely to be hurt by the outbreak. So we are talking about airlines, hotels, and the hospitality sector all taking a bigger hit when we have a virus outbreak. Let's take a look at one of the world's best airlines, Singapore Airlines or SIA. Let's see how the company's stock price performed in March 2003. So as we can see from the chart, the company's stock price actually declined around 12%, which is much more significant of a decline as compared to the STI's decline of around 7%. So this makes sense because tourism declines during an outbreak and more people are afraid to fly. So companies in the travel sector like SIA tends to be the ones that are most affected. On the other hand, there are certain companies like those in the healthcare sector that stand to benefit. So we are talking about companies that produces medical supplies or equipment, pharmaceutical companies, and hospitals. The article went on to state that there are companies that pretty much escape unscathed. So one of the companies that is mentioned is Sheng Siong. Believe it or not, it's a coincidence that I mentioned this company at the start of my video. But going back to my portfolio, there's a real good reason why Sheng Siong is mentioned as a company that will be unhurt in events like the coronavirus. The way dividend growth investing works is that I invest in stable companies which gives a consistent and stable dividend. So these companies that you see here have survived events like the Great Recession of 2008, SARS, and even the current trade war situation between the US and China. They have not only survived but continue to thrive. In Warren Buffett's words, this is because these companies like Sheng Siong have an economic moat around them to protect them from competitors and other external events. Alright, so I hope that this has been a good history lesson of how the market and different sector performs during a virus outbreak. Once again, take good care of yourself and your families. I'll be posting more updates on my dividend growth portfolio as we go further into the new year. And if you'd like to follow along, drop this video a like, subscribe to the channel, or leave a question in the comments below, and I'll see you in the next one.